Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So in this example, I'm going to take U.S. Steel and I'm going to look at the stock that has been as high as $196 in the past 52 weeks. And I'm going to say, okay, with it here at 35, let me look at a cash secured put trade where I come in here, again, have the cash in my account. I can take delivery of the stock, and I'm going to sell the Jan 35 puts, which I think are very expensive, at $4.80. I'm going to sell 10 of them, so it's $4,800. Here we have with U.S. Steel at 35 or higher, just like what we looked at with the British pound when it was 66.50 or higher. In this case, since we've sold the 35 puts in U.S. Steel, those puts would finish worthless at expiration if U.S. Steel is higher than $35, so we keep that $4,800. If U.S. Steel is under 35, in all likelihood, we're going to have stock put to us. And literally, that means, of course, that if the stock's 33 or 32 or 31, they're going to put stock to us. Our effective buy-in price is the strike price minus the premium received. And since we received $4.80, you just subtract $4.80 from 35, and of course you get $30.20. So your effective profit is from 30.20 on the downside to any numbers higher than that. It's a profitable trade. The maximum profit, of course, is with the U.S. Steel at 35 or better. It doesn't matter if it's 35, 37, 40, 47, 50. It doesn't matter. As long as it's over 35, you keep the $4.80. The thing that I'll alert you to, however, is that if we knew that U.S. Steel was, or had a feeling that U.S. Steel was going to go from 35 to 50, we would not just naked sell these puts or do a cash secured put sale, because we can only make a third of the move. We can only make roughly $5 if we sold these puts, which is why our systems over at Option Monster are set up to monitor unusual buying of calls or buying of puts, because hedge funds and the large institutional users of options will routinely go in there and they will buy call options because they get that leveraged upside bet. If they think something's going to happen and they happen to be right, they make a lot of money on that move. They would only make, if they did a covered right, they would only make the premium that they received for those calls. So as all of you might imagine, they're not going to do that trade if indeed they can only make that limited amount. They would do that trade if they thought the stock was going to trade in a relatively limited range. That's when it makes sense to do that trade. So in other words, when I'm looking for unusual buying activity, I'm looking for somebody that's willing to take a leveraged bet, is buying a lot of options, not 5 lots and 10 lots, but 200 lots, 500 lots, 1,000 lots of options, and that they're looking for very rapid upside moves. I'll show you something in just a sec, but let me just move through the slides to finish it off. If we were to collect $4,800 every month against that $35,000 investment, we would generate $57,000 from put selling, which of course is a hideously high rate of return. You're not going to find that, folks, for long in any market, and the fact that Metal, which is symbol M like Mary, T like Thomas, so MT. If you're going to see situations like that in MT or in X or in Nucor, NUE, These are all stocks that we've seen this unusual activity in lately. You're going to get outrageous premiums in there. I'm going to try to harness that and make money from it to profit from these outsized moves. You may have heard me talk about what we did with the exchanges just yesterday and today. Yesterday we were in there buying all the exchanges. Today, for instance, the NDAQ, the NASDAQ, traded up as high as 27.66. That was a pretty phenomenal two-day move if you look at where it came from last Friday, for instance, because I believe last Friday it had closed out at about $21, made it up to 27. Again, this is an exchange, and one of the reasons, of course, that the ISE was the parent company of the ISE was rumored to be in talks with the New York Stock Exchange. So it put a pretty significant premium on all of the exchanges. The CME group, for instance, traded up as high as 238 today, which is a massive move for them. And on a two-day basis, the CME just had a spectacular surge through that, through the $200 level. And even though it finished at 218 or so today, it was at one point over $20 higher than that during the regular session today. So let me see. There we go. Here's a little bit more about some of those ISE, Australian dollar, British pound, Canadian dollar, the euro, Swiss franc, and Japanese yens, and those various associated symbols with those over here. What we do, at times I will follow ahead of things like last week's ECB movement. That's the European Central Bank. Ahead of those, I would look for unusual activity in any of these currencies and then position myself bullishly or bearishly based on how the unusual activity was playing out in any of these. I think the same things that we apply to equity options here in the U.S., which is in here actively trying to buy calls on stocks where we do see unusual activity. For instance, today we saw unusual activity in DRYS, dry ships. If you look at that, they traded over 90,000 calls today, which is absolutely over the top, 90,000 call options traded in dry ships. And the stock surged all the way over 10 today. DRYS has had an absolutely spectacular couple-day move. Last Friday it was under $4.50 and traded through $10 today. I wouldn't just jump on that one now, folks, but we did show, again, strong, unusual institutional activity in that stock the last 2 days. But I would take a look at it, and because we do have that unusual activity, I would look at things like the January 10-12 bull call spread, where, for instance, you're buying the January 10 calls for $2.50 and selling the January 15 calls for $1.20. You're thus paying $1.30 for that bull call spread. It's a $5 bull call spread. If you pay that $1.20 or $1.30 for it, I think you got great risk reward. And I hate to just jump in and chase stocks when they've made big moves like this.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.